Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, Wednesday had quite a bit of movement overnight, apparently. So let's come look at the chart and see what happened. Well, UK CPI data was not very good, so the treasuries moved lower. Yesterday is starting to look like it was largely a technical move. This kind of little bounce that we saw in the treasuries, it didn't go much further than what we had caught, so I'm glad that I took it where it did. But yeah, UK data pushing us down, and yields are now above 3.63. You come over to the S&P 500, never recovered the downside action that we had in the morning. I mean, there was short covering at the end, but it's still down. Granted, that was mostly just a retracement of some overnight upside move. Now in the overnight session, we've moved a little bit lower. So again, the sentiment seems to be shifting a little bit. Oil down pretty big. It's testing its low of the range since the OPEC surprise earlier in the month. Yes, it was earlier in the month. Silver and gold getting hammered there, and copper also getting hammered. So copper getting hammered is interesting. And then Bitcoin. Oh, do we have some news in Bitcoin? Because that's a pretty aggressive downside move there in Bitcoin. The dollar is showing a little bit of strength this morning. We should also check the Japanese yen. So apparently Japanese yen, they are not going to be doing any kind of yield curve control changes this month. It looks like that has led to some weakening in the Japanese yen. So that's basically where we're at this morning. Kind of an interesting lay of the land, if you will. And I think that could provide a backdrop for a decent amount of activity today, especially since it's a Wednesday. We tend to move a little bit more on Wednesdays. And I think that's where we're at. That said, Treasury's having a slight move there on the open, but nothing too strong. We're about to get some Canadian numbers, but we don't have too much news today, but we do have a 20-year bond auction, so we'll see how that goes. Walter, good morning. Every day, man, you've been super dedicated. I'm really impressed. Okay, so here comes the Canadian numbers. Let's just wait for that. Well, no volume in the treasuries off of that, but Brian Westbury, the U.S. faces government spending crisis. Federal, state, and local spending combined is somewhere between 45% and 50% of our annual production. Half of what we work for is taken and spent by the government. No wonder housing affordability and poverty are issues. That's an interesting statistic that I have not heard. It reminds me of this Reddit thread. I'm not going to worry about that until after the stream, but there was this Reddit thread where somebody had posted something saying that the Trump tax cuts had led to a $1.8 trillion shortfall or something. And I'm like, okay, where'd you get that number? Because all of the statistics that we have showed that revenues went up and that revenues were higher than what the CBO projected. So it did not result in any such shortfall. But then people were making some arguments to me about inflation and other things and so forth. They were like, well, if you take it as, the size of the economy, then it resulted in less revenue. And it's like, well, the whole point was you grow the economy more and you take less back out. So if the economy did grow more than you anticipated, and we took less out, we did exactly what was supposed to happen, and revenues still went higher, right? This is like, that's the whole point, isn't it? And yeah, this argument over government spending seems to be heating up online this week. Yeah, because it's tax season and everything. I'm wondering how big of an issue it will be for the election and so forth. Like, let me just put it this way. I have a hard time seeing the presidential debates being a debate primarily or between Joe Biden and Donald Trump, primarily about whether transgender women should be able to participate in women's sports. I don't see that one. I think that would just be too silly. So what are the issues that are going to be actually be on people's minds? I think it's going to be Ukraine and government spending. Well, Twitter has been pretty quiet. What's Anthony Crudele talking about here? When I was 20 years old, I began trading and thought I knew it all and I was going to be rich from trading. I ended up broke and in debt over the next 3 years. By the time I was 30, I had bought multiple seats at the CME, had $1 million year, and thought, this is it. I know what I'm doing now. I got this figured out soon after I had one of my worst runs and a heart attack at 36. How old is Anthony? 'Cause I'm 37. Soon to be 38. I'm now in my 40s. Oh, okay, so he's not that old. Okay. And I remain a student every single day. My ego for thinking I know everything is gone, and I've been in more control of my decision making. This business takes time. You slow things down and think long term, your short term results will get better. Well, I definitely agree with that. You think long term, your short term results will get better. I think that tends to be true. I feel like when you're talking about like development as a trader and going into the field of trading, there's nobody better to talk to than Anthony, because that's somebody who has come in, had like massive success and then massive failures and then come back and so on and so forth. I'd say that happens a lot. Even Paul Tudor Jones says that his biggest losses come after big wins. Yeah. Well, I think a lot of it has to do with both your impact on the market and the market's tendency to, arbitrage away an edge. So if you have an edge, it's working really, really well at that time. It's very likely that other people are going to catch on, and then that's going to destroy that edge, and then you're going to have like a really bad loss, right? And that's kind of how regime switches happen, is somebody gets too dominant in the market and then they get washed out. I can see it happen. Like right now, we're probably at the beginning of a new cycle. Like there was a lot of activity in Discord for a while there at the beginning of the year. I actually saw a lot of people getting it, because I can watch things like, how many people buy Jigsaw through our affiliate links, for instance. We had a lot of that at the beginning of the year. Kind of slowed down in March, right? It seems to be picking back up again, but I think you go through this cycle. It tends to be like a 3-month cycle where like a bunch of new people will come in. They think they got it figured out, and then it all goes awry, and then they disappear. You know somebody that's trading 1,000 lots on the treasuries? Well, I don't know anybody that's trading that big on treasuries, at least. I sure would be interested in talking to some of these guys that are like the big time market makers in the treasuries and are independent, because my understanding is there's at least 1 or 2 of them that they trade really big size on the treasuries every day, and they're doing it all on their own, as far as I can tell. Because I think Uzi has talked several times about you can go on the CME website and look at who is a designated market maker, and there's one that's just like a guy. And I'm like, okay, so like what things do you use as your support? Because surely you're not doing it all by yourself. Yeah. Do you have employees that help you? What, like, news sources and other kind of resources or subscriptions are you using? I would love to know that stuff. Yeah, well, you don't really do want to talk about it too much, do you? Because you don't want the edge to go away. Like the other thing is that when you first get started in trading, man, this market seems really heavy to me. Even though it's been slow here at the beginning, it looks to me like they want to push rates a little higher. He says anyone can do it. That's probably not true. Like here's the thing. I think that we as humans vastly underestimate what our own abilities are compared to other people. Like, you do something and it seems like it's a seemingly simple thing to you, and you think that everybody can do it, but then if you go into the venture of trying to show other people how to do it, all of a sudden you find out that, like, actually it's not such a simple thing. And I'm doing a ton of stuff. Like, I would think that most people interested in trading are above average intelligence, and yet few are successful. Yes. Well, and those that are successful, I think that there's a lot of luck involved in it, right? Like, the market is very statistically efficient. How did you find something that gives you an advantage? There has to be some luck to it, I think. either luck or just like crazy perseverance, right? No, so like if I were to teach other people how to run a stream, just how to run the stream and to keep talking, and how to analyze what we have going on in the financial markets, you know, like, to me, I just do it, and I've always just done it, and I guess I've learned along the way, and you optimize along the way, but I just started doing it, you know, and so to me, it's like, oh yeah, anybody can probably come in and start a stream, and, you know, if they're an affable person and they're good with people, they probably do better than me, right? But the reality is that a lot of people find it very, very difficult to get on in front of a bunch of people and talk for 2.5 hours, you know? It's just like, we really don't have the full capacity to understand what other people are thinking, because, again, your brain is a neural network, right? One of the abilities of this neural network is its ability to load and even mix different learned training sets. So like when you're dealing with neural networks, you'll set up the network, and then you'll send it training data, and then the training data will set weights in the neural network, and it will create new nodes and all of these things until it learns and it creates the framework for whatever it's going to do, right? Well, the human brain can take that framework, and it can say, oh, okay, I'm in this context, so I need to use this one now, or I need to use this one now. That's like a really big leap forward that machine learning hasn't quite made very well yet, right? And not only can we do that, but we can say, oh, here's this context and here's this context. I can combine those together and use those together. It seems like that's also something that the human brain can do, right? So what we will do is we'll say, okay, I want to know what this person is thinking, so I'm going to generate a model that of what I think their model looks like, and then use that to determine what they may be thinking. And the issue is that because you're not within their mind, you don't really accurately know what their model is like, and so our expectations and estimates of what other people will know and do and so forth often tend to be very bad, right? I don't think trading has anything to do with intelligence, but rather knowledge. Well, so when you come down into the why do most people fail, the biggest thing that I see is that humans are social learners. So what they always try to do is say, okay, how are other people doing it? So Anthony Crudelli was talking about this. He had a YouTube short yesterday that was, I think, a clip from his show. He said, like, what's your trading pet peeve? And he says, just because somebody else has had success with it doesn't mean that you'll be able to do it, right? Because you might not be able to actually think the way that they think and do it the way that they do it, right? So, but that's the approach that almost everybody takes first, is I'm going to go and read the internet and learn the common things about day trading, and then I'm going to become a good day trader. And if you've been in this long enough, what you realize is that what you're doing is actually setting you up for like the worst trap, right? It's going to set you up for all of the things that the market preys on. So to really be successful in this field, you have to be good at hunting for the things that nobody else has, right? That means doing research on your own, really diving deep. Like, you've got to go deeper than Reddit. If there's a Reddit thread about a certain thing, you go and you look at the top comments on Reddit about that particular issue. those things are not going to provide you an edge. And if you try trading off of those things, you're probably going to get screwed, right? You're going to have to look for the things that like nobody else is saying, but end up being a significant factor, right? And that's really hard. And very few people actually have that approach to life, right? A neurodivergent person may actually be more likely to have success in that arena merely because they end up doing their own investigation and being very curious and so forth, right? Whereas your typical person will just walk right into the trap, right? I think that's largely why so many people fail out. Like everybody says, well, you know, the stats are you know, 95% of traders lose. Those stats are higher than is really, you know, because most of those people don't know what they're doing and just come in and try it for like a week and then wash out or something like that. Well, there is some truth to that, but I have seen some stats and studies that suggest that even for the people that trade a year, 2 years or more, that 60% of those lose everything that they put into it, right? So, you know, the people that last longer than that that figure out that, oh, I can't just do what everybody else is doing, right? Yeah, looking for the holy grail trading system. You know, I said I was going to make this video like 5,000 subscribers ago, and I kind of didn't. and I should probably look at it again. But because I don't think that the holy grail is the correct like allegory, right? I think that the correct a more useful framework for like how do you develop a trading strategy would be achieving trading nirvana, which is to say that you are in line with what the market is doing at that time, if not ahead of the market, right? Rather than some set piece of truth that lasts forever, because it just doesn't exist in trading. It can't. I guess trading requires you to have the right perception of the market data and you receive and how well informed you are. You can be very intelligent, but if you don't have the right perception of the market, I don't think it will work either way. Yeah, I agree with that. I agree with that a lot. I think that another one of the big problems that leads to so many traders failing out is that the popular culture about the market is like so often dead wrong, right? Like the culture among retail day traders is that the market is efficient and the current market price is reflective of all available information. That's not true. So what retail traders do is they look at what the market is doing and then they try and sort out what the actual underlying fundamentals are based on what the market is doing. And if you do that, the inevitable conclusion that you're going to come to is that what the market is doing is not reflective of what the fundamentals are, and ergo the fundamentals must not matter. That I just got to figure out something about the technicals that gives me an edge, right? Well, the technicals are very, very statistically efficient. And like that's the problem. So that the market is statistically efficient, but informationally inefficient. That's the exact opposite of the approach of what I think most retail traders do, right? Most retail traders come in and say, well, the current price tells me everything that's like already out there. And it's very unlikely for me to be able to have a piece of information that like the market doesn't have or the market doesn't expect, but I can come in and I can find these patterns that will consistently give me profits, right? That would suggest that the market is very informationally efficient, but is somewhat statistically inefficient. And it's just not the case. The market is so statistically efficient, like you're not going to be able to use your standard high school level statistics to find an edge in the market, as far as I can tell. Like, So I was reading my machine learning book yesterday, because there was some chapters where it's like, well, I went through that and I don't know if I understood it very well. I certainly don't understand the math. Man, one of the things that I don't like about this book is that they'll come in and they'll say, okay, like here's an equation, and then obviously this happens and this happens. So I'm like, I don't know how you did that. You're using a bunch of laws and other mathematical things that I'm not familiar with. I don't know how you got from here to here, but I feel like I'm still kind of getting like the higher level ideas. So the thing that they were talking about was like Bayesian learning, because I didn't understand. Well, okay, so I understand what Bayes' law is and everything, but how does that turn into like a machine learning strategy, right? Well, it comes down to the difference between like an Bayesian approach and the more classical approach. So like the more classical approach is kind of what you're taught in high school. Is like you take the number of observations, and then you take how many turned, like if we're flipping a coin, you take the number of times the coin was flipped and the number of times that it came up heads, and then you can get what the probability of that coin coming up heads is, right? But the Bayesian approach is kind of answering the same question, but in a different way. It's saying, okay, I have a theory, like my theory is this is an equal weighted coin. Based on the data that I have, what is the likelihood that this is an equally weighted coin, right? It's asking a different question, even though like the answer comes out to be 50% or whatever that tells, right? With Bayesian learning, you can come in and you can say, okay, so here's my priors, here's the information that I had before, and then here's my new data sample, and then I take that and how does that change my likelihood estimation, right? And once you move into that framework, now you have something that's iterative. Now you have something that, okay, we have this likelihood estimation and it changes with each new data point. And that's what allows you to do like an iterative machine learning process on it, right? So you have to shift yourself from the framework of, okay, there's a percentage chance of the thing happening, to actually this is a probability distribution, and what is the likelihood that this probability distribution is actually, that's what the probability distribution actually looks like, right? Like that's a big jump, I think, in understanding of statistics, one that I'm having a hard time making, right? But it seems to me that to get into statistical methods that are like actually effective in the markets, like that's what you have to do, because all of this stuff that you could find from like a just pure classical statistical perspective has already been arbitraged out of the market. The only true edge for an average retail trader is to simply trade less. You don't have the technical resources to capitalize on anything else. It might be. For perspective, companies out there pay billions of dollars to be headquartered closer to the exchange just to capitalize on pings alone and the market neutral strategies. That's why we make legends out of traders. They get really lucky for time and written into the history books entities. Yeah, no, I think so. Well, like just going back to Anthony Crudelli. So you gotta understand, I really like that guy, right? He had like he was saying in that tweet that kind of started this. He had $1 million year, and then after that he had a really bad losing streak, and he had to like completely start back from ground one. So what happened, as far as I can tell, was Anthony Crudelli was on the forefront of the shift to the electronic trading. He was on the electronic terminal before anybody else, and because of that, he was able to become very large, right? And then when the electronic trading thing became more popular, he had that 1 year, but then at that point, it was big enough. The market shifted on him and changed and came after whatever his strategy was, because a lot of it was technically based, right? Yeah. Retail communities talk about blowing accounts, while the legends we talk about blew up sons they'll never be able to accumulate multiple times over. Well, I do find that if you get these guys that have like big time success and they just keep trading, that they very often will give up what they had, right? Like I've had periods of success in the markets where it's been like, I did well for 6 months to 9 months, and I could go in and say, oh, look how well I did in this 6 to 9 month period. I doubled my money, whatever, and then just sit on that and tell everybody I'm an amazing trader forever and just always rely on that. Like, but it's not the full story, right? Because then you come into a market that you don't understand and you do terrible. Let's make it simple. What model? Well, there's so many different kinds though, Mr. M. Yeah, retail chumps blow up an account and quit. Legends blow up an accounts before me. Well, I mean, I think there's this other side, because there's kind of the question of like, what are you trying to teach, right? So one thing that we're trying to teach is a market shift, and markets are very statistically efficient, right? So and that large outsized success is more likely to come from luck, right? That doesn't mean that there's not any skill to what you're doing in your trading, but could be some luck about that. That's what you were trying that strategy at that time and in that particular market, and yada yada yada, right? And when I say luck, what I really mean is it's not going to last, right? There is a very, very, very small group of people that do end up having success that is not just luck, right? So Renaissance Technologies probably being the best example. Now, I think that part of why Renaissance Technologies has been able to be so successful is because they continue to evolve. They know how to size their trades so that the edges that they do discover are less likely to get washed out. But from what I've read, they've had plenty of things where like they stopped working, and they're constantly looking for new things, and so they're able to find new stuff. In the beginning, Renaissance Technologies was basically just doing standard momentum CTA strategies, which, it kind of seems like if you want to go the professional route, like what we were talking about the other day, if you want to start out as a CTA, it's probably better to do a CTA strategy. You won't, there's so many of those out there that be hard to attract, stuff, but that's kind of like the sure bet to, get fees and so forth. But then Renaissance Technology was taking a very, very quantitative approach to it and kept evolving and found things. Hold on, I didn't close my blinds yesterday. I kind of opened and closed them for my plants, and it's too bright. I want to close it. Hold on. What are the implications when Renaissance Technology is able to do so well? Doesn't that imply that price can be predicted and that they are doing it? Well, so I would say that future orders can be predicted and that they are doing a yes. I think you got to be specific, because you can have situations where you're able to predict the orders, but price doesn't react quite in line with what the orders are doing. And so you were able to predict the orders and not the price. But orders are largely what moves price, right? But there's randomness inserted into the price. That's why you can't, you know. The best indication of future returns is going to be your ability to predict the orders, because your ability to predict the price is so limited. There's still a seller at 04 in ZN, but he doesn't seem to be making a dent in the price. I'm surprised. Well, you know, it hasn't been a whole lot of flow yet so far. Maybe a little bit of buying in the 5-year. So, you know, that's like a break of the opening range high, but the market doesn't seem to be reacting to that too strongly. It kind of looks like that the market probably isn't going to care about like stopping out and that sort of stuff until we get to like 114.08. Anyways, it seems to me that Renaissance Technologies has found some insights about the market that would be a really big deal if they were more widely known, and that it is inevitable at some point that other people will discover them and it will get out. And I don't know if we'll ever know that, you know, they'll say, oh, you found it, that's what we've been using this whole time. I don't think that Renaissance will come out and say that, but I think that there's probably some things like that. And I think that it would have a lot to do with one of the things. I'm just kind of trying to like take bits and pieces of what I know from them. What I think it is that they're able to watch the flows in these instruments and kind of know, based on looking at the whole picture, where certain other flows are going to come in and front run them. That's what I think they're doing. Is they know that, like, okay, there's this thing going on in Japan and the Japanese yen is moving yay way. And what will happen when that whole system ends up playing out is that over the next few days, you're going to see money go here, 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 and here, and they can predict that. That's what I think they're doing. It seems to involve like a multi-instrument analysis sort of a thing. Because I saw some of that at Goldman. So one of the big innovations that they have at Goldman is their securities database is an object database. So they'll have an object like the 10-year treasury, right? Say the 10-year treasury, and here's what the yield is on the 10-year treasury. And then you can have all of these other assets like banking stocks. And the banking stocks will say, okay, here's how we value what the banking stock is. One of the inputs into that banking stock is the interest rate, right? So they can determine, based on what the interest rate has changed, what the value of this stock has changed, right? But here's the thing, is like the value of all of the stocks change, and then that affects the value of the S&P 500, and how well the S&P 500 is doing could potentially affect the future trajectory of interest rates, right? So there's like inevitably going to be these circular references. And what they did was they developed an algorithm, kind of like regression. So let me explain regression real quick. The way that you do regression is you come in and you say, or let's not do regression. Let's do cluster analysis. So like if I have a bunch of points like this, there's a bunch of points in here, there's a bunch of points over here. And what I do is I say, okay, how close is this point to every other point? And I categorize it based on that. And I might get like a box like this when I start out, right? And then I do it again and I say, okay, what is the center of this box? And how close am I to that box? and what's the center of this box, and how close am I to the center of this box? And if I'm closer to this box than this box, then I'm actually categorized in here, right? And then you run through that all right, and some of these points are going to get categorized, right? Now it's going to be, this box is going to be for here instead of here. So this point is in this box, not this box. And then you run and you do it again, right? And you do that over and over and over again in an iterative process until no points changed. You've gone through the iteration twice and none of the points have changed, right? And what they were doing with SecDB was very similar. It was like they were running through the loop multiple times until it didn't change. And there was like certain rules about it and stuff. It was like really complicated math stuff to prove it and everything, but they had a thing like that. So like the advantage there is like having this high level view, being able to model like the whole market and like every security. And I suspect that part of what Renaissance Technology is doing is something similar to that. And if that is the case, then kind of taking this high level view of the market is like, okay, so today we came in, there was Bank of Japan news and there was a CPI news and the treasuries are moving. The treasuries moved down. The dollar has got a little bit stronger. It looks like now this morning it's getting weaker again. Yeah, it looks like all of that has unwound, right? But, you know, where's the money coming from and where's the money going to, that we as retail traders can kind of sort out some of those moves and predict them, right? But Renaissance Technology is able to do it at a market level on a wide scale. That's what I think they're doing, but I don't really actually know. And if they explained it to me, I probably wouldn't understand it. That's the thing that really sucks, is that what I should have been doing is I should have been going to school. I could have still done computer science, but maybe have stuck around to do a master's in mathematical finance or something like that. And then, or even tried to go and get a PhD and then go and work at a firm like that. Like that's what my path should have been. And I didn't realize that's what I wanted to do until it was too late. So it was just like, okay, we're going to graduate and try and get in a finance company and see where we go. And then I ended up learning enough things to kind of know where to look, but I still had to learn everything myself, right? So I'm a little, I feel under, at a disadvantage. Like ultimately the way that I want to go, there are people that go out there and do it and take that quant perspective, and I can't, I have to just learn it a little bit at a time, and probably will never quite catch up to them. Actually, it says that what they do is pretty much known. Well, so I do see, or I have heard things about that they're also doing statistical arbitrage, but it seems to me that they're doing a lot more than just that. And we should point out that while Renaissance Technology still does really well, they do not do as well as they used to, right? So surely the market has caught up to some extent. Read about the Millennium Legal Ban. Oh, I think I have heard about this. I'm trying to find a quote here in this article that I can read to you guys. Renaissance's alleged trade secrets are nothing more than general ideas that are well known to people familiar with statistical arbitrage and quantitative finance. Right. But what I'm saying is you're presenting that as that's all they're doing. And I'm saying that's probably only one part of what they're doing. So of course they would put up a big stink about it, but of their proprietary information getting out to dissuade anybody from ever leaking it. But I doubt that that's all there is. Can anyone be a liquidity provider if they place a limit order? Is it volume that distinguishes a real market maker? Oh, I didn't hear what. Yeah. Well, I was talking about how SecDB was working, and I was saying it seems to me that they have a way of looking at like the market as a whole, and as you're doing that kind of statistical arbitrage on the market as a whole, you can predict certain flows that are going to come into certain instruments long before they happen and front run those. I think that that's what they're doing. So I think I think that there's some steps further than just statistical arbitrage, although statistical arbitrage is probably a major part of it. Right. But I think that this is what hedge funds are doing in general is I didn't come up with this idea. I mean, this is Jean-Philippe Bouchot's idea, right? But in his paper, when he talked about his paper about the inelastic markets hypothesis, he says this appears to be what hedge funds are doing anyways, is that they spend tons and tons of money paying for proprietary flow data that allows them to identify like what funds are doing and then run statistical analysis on that in order to predict certain flows that are going to come into the markets. So essentially they know what the index funds are going to do or whatever long before they do it, and they're able to capitalize on that, right? So it is basically front running. All right, now, so to Trading Bunny's question, can anyone be a liquidity provider? I mean, from the strictest definition of the term, we could say that anybody that has placed a limit order is a liquidity provider. At that time, yes. But typically when we talk about liquidity providers, we're probably referring more to a large hedge fund like Citadel, for instance, that largely makes their money from providing market liquidity, and they have lots and lots of orders out, right? Insider trading question mark. Well, that's the thing is it there starts to come a point where there's kind of the line gets fuzzed, right? If I know that this index fund is going to do something, well, you would say that that's insider trading. But if I know that just from looking at the market and knowing enough about their strategy, there's nothing wrong with that, right? That would be different from if an employee told me that this was going to happen and then I traded on it, then that would maybe be a problem, right? But like, the further into that you get, the more fuzzy that line becomes, I think. I think this is why. So one of the things that I've always noticed is the professionals that I've spoken to. If you talk about something like insider trading, for instance, right? You're going to get a lot of those people. I would say that that type of person is more likely than other people to say, well, if I have any information, I should be able to trade on it. And, it's a victimless crime and those sorts of things, right? And I think the reason why you get that is because ultimately, like, where does edge come from? It comes from like knowing things that other people don't know, right? Being able to predict those orders before other people. And so to some degree or another, any kind of like really profitable strategy that you're seeing people perform at a high level, if you explained it to the public, there would probably be people in the public that would claim it's unfair, right? Because their idea of the market is like everybody is supposed to know the same thing, and then we're just doing our analysis on it, and some people do a better analysis than others or something like that, right? But it doesn't really work that way. Like, if that really was the market, if the market was informationally efficient like that, then trading would just be gambling, you know? The reality is that some market participants know things that other market participants don't. And I think the whole key to successful trading is realizing when you're that guy and when you're not. I'm making my way through the trades quotes and prices book, and it's discouraging to think that I have no edge. Yeah, I know the part you're talking about, because there's this part at the very beginning that basically says, like, unless you know something that the orders are coming, there is really no point in trading, because you will always lose, right? In the long run, because of the way that the market is structured, if you don't have an active edge, you will lose everything eventually, right? Yes, but keep reading, because they come in and they say that, but then the rest of the book is basically proving that actually you can predict orders, and that there's actually some really interesting, like, none of these behaviors that they talk about are like huge things that are like, okay, you see this pattern and you take it, and you'll be able to make this much, and here's your stop. They never do that, right? But they just say, okay, market tends to follow a square root law. Okay, well, what can we gain from that? If I take a long and I'm an intraday trader, and we've started to reach that area where the impact starts to really follow a square root law, then the upside to you is significantly diminished, and it might be a good spot to just take your profits, because there's going to be a lot of liquidity and volume in that one area, and you can get out, right? Yeah, how do you compete with these guys for the information? Yeah, I think that what Akshay is saying is a good so the thing is that if I know a piece of information, this is where it gets really weird, okay? If there's a piece of information about the market, okay, and I'm literally the only person that knows it, like, I'm literally the only person that knows this thing about the economy, and I want to make money on it, like, right now, today, that piece of information may actually be useless to the trading if I'm the only person that knows it, right? Because if I'm the only person that knows it, why would other flows come, right? So I don't want to be the only person that has that information. I just want to have that information and am in on the trade before other people find out about it and their volume comes in too, right? So I think that's what Akshay is kind of saying, is like, you want to kind of predict what the large players are going to do based on the circumstances, right? Look for signs that they're actually out there executing, and then, like you said, try and ride on their coattails and just take a little bit out of it. I'm not sure how to calculate the square root law with real prices. Well, okay, so we can measure it like, like there's a bunch of different measurements that come out in the book, but the most simple one is the y omega times the square root of the size of the meta order over the total volume for the session. So for this, you could come in and you could say, this is the average, this is the ATR. You can say this is your average true range over the last month. This is your average volume over the past month, right? And then you would have to have cues, which you might be able to sort out from like saying, okay, here was a big move. How much volume happened on that one big move and how much did it move the market? And then you could calculate the Y that way. Or you could just kind of like guess on what the Y is and get like general estimates, right? But in practice, for our purposes, you don't have to be that specific, right? For our practices, all we have to do is see the law start to come into place. Because what will happen is, in the beginning, it's going to look like it's linear, but then there's a certain point at which it starts to become a square root, right? This is what your graph is going to look like, right? At what point do you decide that, oh, actually it's not linear, right? How many data points can you get until you realize that it's not linear? And it's, somewhere in this area, you're going to realize that it's not linear. So you will see that on the order book, right? Because what you're going to see is lots of volume trading in one spot, the bid and offer in that particular place not being very high relative to where it was, the flow kind of starting to become a little bit more sporadic, right? They're going to trade it up 200 contracts, down 200 contracts, back and forth like that. And when that happens, like, yeah, they're able to go a little bit further, but like it ends up being a lot slower, right? And now all of a sudden you go, oh, well, we're getting the square root law coming in, right? That's as far as they can go for that time. So they're gonna kind of back off. It might come back a little bit, and then if I think there's another leg, then I can wait for the other leg, right? But once I start to see this, I get out. And that's how I do it, is I'm just watching the book for the signs that's coming in. It's like, I know what it's going to like. I know what the graph is going to look like. I can look in the book to see when that kind of that convexity starts to happen, right? So it doesn't have to be that exact. You know what I mean? I do it all the time. So remember yesterday, we were having that move up, and I was like, oh yeah, here it is right here. I want to get out, and I didn't quite get the one that I wanted, and so I got like 4 ticks lower or something like that, right? Oh, just okay, thank you. I was gonna say, once you start to see it, it really becomes like, oh wow, why is this not talked about more among retail traders? Because there really are these clear spots that, like, look, it'll come back and then go longer, and if you hold through it, it'll go longer. But just determining, is there going to be a pivot here and it's going to go back a little bit lower in the short term? You can absolutely pinpoint those areas with the order flow. It's just that it's useless to you unless you were already long down here, right? If you're already long, then excellent profit taking place. And it's a law. It's a behavior about the market that you will literally see every day. So it's actually really interesting that it took them so long to figure it out, and that retail traders are so ignorant of it. But it's because it's a behavior that the human mind is not really very good at seeing, right? Or be a complete degenerate and lever up instead of taking profit. Well, I keep looking for this situation where that's what I want to do, and it keeps not happening. I think the reality is that the kind of moves that happen like that maybe happen like 1 to 5% of the time. So they're kind of hard to catch. Hey, NASDAQ Technologies, how you doing? Actually, it was known since the 60s or so. Mandelbrot wrote about it. But the MIT clique was against. Well, okay. I wouldn't say that it was like well established in the academic literature until the 2000s, right? But probably, I think it's probably the case that there was people all the way back in the 1800s and 1920s and so forth that probably understood this law to some extent, huh? And I bet that there was a lot of people that understood this law but didn't understand that they understood this law, you know? like if you went through and described it to them, they'd be like, oh, so this is why I do this and it goes like this. But you know, they never actually wrote it down in an equation and that sort of a thing, right? Right. No, but you're saying that there was papers submitted for publications, but were rejected. That could be true. Okay. If you can you find me specific examples? Well, you're saying Mandelbrot wrote about it, so. I wonder, so this is something when, you know, I haven't gone down the Mandelbrot hole in a while. So this is one of those rabbit holes that I think every trader goes down, right? Because when you read Mandelbrot, which book specifically? So I'm only really familiar with one of his books. But when you read Mandelbrot, I think it's hard not to read Mandelbrot and think that he was very much onto something, but it wasn't quite there. That there was just maybe like one innovation further, and it would just completely explain everything, sort of like that's what you get when you start looking at Mandelbrot, like, right? Yeah, the misbehavior of markets is the one that I'm familiar with. But I don't know if I did a deep reading of that book. I just skimmed chapters and read 1 or 2 chapters on the specific topic that I was looking for on that book. I don't think that I read that one cover to cover. But I know, like it's just like when you look at a fractal, you can see the pattern, and you're just, it's impossible for a person to look at that and not be like, oh, okay, so then if I go into this area, it should look like this, and it should look like, but then you actually go into it and it's like, oh, it's like so much deeper and more complicated than I thought. And like, oh my gosh. And how can something so simple lead to so many complex patterns? And it's just like, it goes on forever and ever and ever and ever. Like, what the heck? Read the papers and articles, your references, and okay. So anyways, that's one of those rabbit holes that you'll probably go down as a trader and like waste a ton of time on. Because I think the reality is that there are still like really, really big innovations and discoveries to make in the areas of the fractal nature of the market, but probably none of us are smart enough to be able to figure it out. I still wonder. So there's this. So let's talk about the fractal nature of markets. So the way that what makes something a fractal in reality, because people will say, well, because there's this pattern right here, and then there's this pattern right here. So there's the same pattern that you have here, and then you zoom in, it's the same pattern, and that's what makes it a fractal. Well, okay, that's like a tendency of fractals, but what actually makes it a fractal is that you have a function, right? Equals y or whatever the deal is, and then that's iteration 1, and then f of x2 is actually f of y1, which means that you take the answer from the previous iteration, and that becomes the x value for the next iteration. That's what makes something a fractal, right? So the market is very clearly a fractal to some extent, right? We're doing this calculation of what the current price is, and then all of the market participants take that current price and factor that into their calculations and use that for their next submission of orders. So to some extent, the market is a fractal, right? So the question is, can I figure out what the f of x 1 million is? 1 million? How do I do that? Okay, well, I can start with the f of 0, and I can just keep doing that calculation a million times, right? But is there a way to figure out in constant time what the f of 1 million is? We don't know. I kind of suspect that you can't, but unless there's been some developments I'm not familiar with, I don't think we actually know, right? So there's this whole thing like, if I want to do a zoom in on Mandelbrot, you ever seen those animations? Like they take, like some of these animations that you can see on YouTube took months and months and months to render, right? How do I see what it looks like right here at this particular spot? You have to do the calculation. You have to do it. You can't just do it in constant time or continuous time, right? But we don't know. It kind of seems like it might be possible. It seems like it might be possible. So that's the hole that's where I say, like, there's this deep hole, right? And like I said, there's so many mysterious and interesting, like you can waste a lot of time on Mandelbrot. I don't know if reading Mandelbrot actually will find that you'll actually find edge from doing it, but it's a rabbit hole that every trader goes down. Okay, Robert Doe asked about how can we estimate the probability of being in the right queue position in order to catch the edge? Well, okay, so if you're talking about like a market making scalping kind of strategy, okay, here's how you figure this out, okay? If I wanted to get into the market right now, okay, so I can see I could, let's say I wanted to buy. I could buy at 05, or I could put a limit order at 05 half. If I put a limit order in at 05 half, there's 1,700 contracts in front of me. The last time that we traded up, there was 334. So, point number one, if I put an order in there and these orders in front of me pull and it trades down 300 contracts to fill me, okay, I would get filled. That's actually a likely scenario. Let's just see what it does here. There's 100 so far, okay? But if it does that, that's not necessarily what you want to have happen, is it? Is like, because if it does fill you, like, what's going to stop them from going to 04 as well? Right? So if I'm going to get in line at Okay, now it's 24.32 and plus the 600 in front of that. But let's just say that I think that the correct price is still 04 half, right? And they don't pull. That means that there would have to be 24,000 contracts sell in order for me to get filled, right? And then on the other side, probably 2,700 contracts to fill me on the other side. And the question is, how much volume are we seeing right now? How long does it take for there to be 27,000 contracts, right? And if you're only trading 27,000 contracts like every 5-10 minutes, that trade might not necessarily make sense, right? So that's kind of how market makers figure this out, is they're looking at like, what is my position in the queue relative to the actual amount of volume that's going on. And what you would prefer to have is a situation where the price is too high or too low, and the amount of volume that's coming through at that time is enough that you should be able to get filled on both sides very quickly, right? And is preferably if you can do something where, like, you know, I think that this price is really likely to get hit, or hey, I have a really good position. Like maybe I'm the first person in line at 2304, and I can say, oh yeah, I probably can easily get a fill at 05. Okay, now I'm filled, and now, you know, it's only going to take even one order at 04 half for me to get out, and I've made my profit, right? That's the basics of how you do it. Please don't teach people market makers. Well, so who was it that told us about this? Because they told me about this, and I went and I found the study they were talking about, and they were correct. These guys did a study basically where they looked at different types of market participants that were known to be successful, essentially, and they were kind of figured out, like, what are they actually doing, right? So are they just sitting out there with limit orders and just taking the fills? Or are they in some situations being aggressive and like making things happen, right? And in that study, they had found that the ones that were the aggressors were more successful. Which I think the way that I would take that is like, okay, if I'm doing a market making strategy, I could identify 05 as a price that's, you know, too low or whatever the deal is. So if they fill at 05, then I definitely want to take the fill there, right? Okay. But another one that you could say is that 05 half is too low as well. And there's an offer there. So I can hit into it with a market order, and I'm quite likely to see it go up to 06, right? And that is coming in with the market orders and kind of like shoving the market. And you can see that in certain situations where this asset moved and then the market orders flood in and push it to come back in line. And my understanding is that those strategies are more successful. So it is the case that many of these very successful, let's call them high frequency trading algorithms, are often aggressors. That the algorithms where they only ever place market limit orders are probably the minority. That most of them are probably somewhat of a mix. Questions about catching the edge are being made in order to build a better understanding of momentum in order flow and making better entries with that. Sure, market maker and HFT are technically different. They can overlap. I think I can go along with that terminology. I think that from, like, again, there's this perspective of like etymology, how the word has been used in the past, how people use the word right now, and like, but then there's also the approach of what would be the most effective terminology in teaching people. And so from that perspective, I think that using the term market maker to mean people that are only providing liquidity and using limit orders has a lot of use, because then you can talk about theoretical setups where you're only placing limit orders and what the advantages and challenges of that are, right? And if we have to say what a market maker is like way more nuanced than that every time and everything, it kind of like, it's just like this extra little thing to be precise that's not useful to people, right? So I think it's better to say that a market maker only provides liquidity. But I'm just saying, like, when you look at the high frequency trading algorithms that are out there, the majority, as I understand it, the majority of them are not purely market making. But we're not talking about something that's empirical evidence. It all depends on what we decide to define things as, right? Whether a particular player is a quote market maker versus just an HFT depends on what our definition of a market maker and what our definition of an HFT is, right? It was just like what we're talking about with order flow, right? Is order flow the data, or is it a strategy? And if it's a strategy, what actually qualifies it as the strategy of order flow? Well, okay, the market maker is a legal agreement for one. Yes, but again, like, definitions could mean different things in different contexts, right? I think that the way that the typical retail trader uses the term market maker does not necessarily necessitate that they're only taking limit orders, for instance, right? But in my definition of a market maker, I say that they're only providing liquidity, and I'm only saying that just because then I can talk about strategies where you're only providing liquidity, right? Versus strategies where you're only taking liquidity. But I guess where it matters is when we come in and we say retail traders don't have much of an edge because of the robots. Okay, well, what is it that the robots are doing that we have such a hard time competing with? And what I'm trying to say is it is more than just they got a good spot in line, right? Because if you were talking about market making in general, having a good spot in line is a really, really major factor in being successful at that kind of a strategy, right? And I'm saying that the things that the robots are doing that are hard for the humans to compete with is more than that. They can be the aggressors, and there's real advantages to being the aggressor in a situation where you really have the edge, right? And that's what, sorry, Roberto is trying to figure out, right? Or on the split side of it, people say, well, I want to be a market maker. And then because I want to be a market maker, I can only ever put limit orders out there. And I'm kind of saying, well, if you're a retail trader, it would probably be to your advantage to understand that there are some situations where it totally makes sense to be the aggressor, right? Yeah, if you're an official market maker, then you're earning a rebate by providing liquidity, right? Or you have some sort of a legal agreement to provide liquidity in some manner. That could be one. So we could differentiate what is a market maker from an official designated market maker, right? The most important thing to me though is how can we structure our language to better help people learn and understand what the market is, right? Because what I find time and time again is that gurus will fuzz and play with definitions of things to mislead you, right? So like this is the case with price action, is that it's really hard that they're weaponizing language against you. Nobody's going to come in and say that the price moving doesn't matter, right? Well, it matters. It matters in as much as that's how you make money, is the price moving, right? Okay. But the reality is that they're just taking your standard technical analysis setups and they're just calling them something different so that they don't have to market it as technical analysis. Because if they market it as technical analysis, nobody's interested. Like the technical analysis brand is damaged. So they came up with a new term that is, comprised of existing words, price, action, in a manner in which you're likely to have a positive association with it, and so you're going to think, oh yes, this strategy absolutely works, and people fall for it, right? And that's where I come down on the issue of order flow as well, is that in all of my reading of the literature, order flow refers to the data and not a strategy. It's either the data or like a view of the market, but it's not a specific strategy or a style or category of strategies. Oh, unless it is the strategies that utilize order flow, right? And so one of the things that I'm starting to see people do is they're trying to enforce a definition of order flow that basically makes any strategy that's not theirs illegitimate. I have a problem with that. I don't think that that's useful to people in learning. I think it's more useful to people in learning to go with the definition that I see in the literature, which is order flow is the data. The order flow is the study of all of the orders in the markets, including the limit orders. Right? Understand the data, then you can understand the kinds of analysis that we can do on the data, and then we can understand the types of strategies that we can create from that. Yes, is choppy. Well, it's been 20 minutes and they are in a crazy tight range today, right? This is like what, 6? No, it's less than that. It's 8 to 4. Yeah, no, it is. It's a 6-point range in ES. That's super tight. And the treasuries too. Like we had this move from here to here, and then it's just kind of gone quiet. That's not a market that really wants that I look at and I'm like, oh, I really want to be involved, right? Beat the market maker in their own game. Yeah. So this is another thing you've got to understand. And on that one, so here's another thing that happens, okay, is you'll have a lot of teachers that are really good teachers, and they're saying things that are 100% absolutely correct, but then the audience misinterprets it because the audience wants to still go with what they know or doing, and so they get that. So for instance, I find this happens with Futures Trader 71, right? Like in almost every video that I think I've seen from him, like on the webinars that he did for Futures IO and everything, the end he basically says like, we can run all of these statistics and everything, but in the end, like the real edge comes from the risk management side of it, that like you're taking on risk in a short time period to allow your winners to run and then take advantage of that property of the market, and the actual setup is just to like make you consistent about doing it. And you have to be able to manage the risk to understand the situation where doing that is not a good idea, right? And if you don't, then that's when you take the big loss, right? I don't think that his audience understands that, because what I hear from people when they're talking about volume profile and stuff like that, they don't get that. That's why I want to go and do this backtest to show people that like, okay, like here's the setup that you guys are trading. If you just take that every time, it is not a good setup, right? So the edge is not actually coming. Like you think that the volume profile is predicting something, but the actual predictive value of it is it's not really predictive necessarily. It's just good at identifying maybe areas of interest. And I don't know if those areas of interest are actually advantageous to you or not. I'm not able to find any data that supports that they are, right? I see that happens all the time, right? So to what Roberto was saying, I see that happening in market making too. So like if you're talking about Gary, because Gary's the one that really is pushing like the market making style of trading, he doesn't say be the market maker at his own game, right? He pretty explicitly says you don't want to trade against other market makers, and you don't want to trade against the big professional traders. You want to try and trade against other retail traders. That kind of implies that you're going to be looking for situations where that market is just really inefficient, like there's nobody there. Because if there's already a really established market maker that's really good, then there's no opportunity for you. I was watching a video from Coding. I know he hasn't posted anything recently. I think that he got like told to stop making videos or something, which is kind of sad. I remember you said, oh, by the way, if you want a guy that's doing quant stuff, look for Filthy Quant. I don't know if he's posting stuff still, but I don't like that guy's attitude. He seems too full of himself. Okay, yeah. So here's why. I don't want to trash him because I think he's a good guy, but I see this happen. Here's what happens. Okay, like look. I'm a programmer. I program for a living. I have a day job. Okay. A lot of people would say, oh, well, if you're so good at trading, why do you still have a day job? Why don't you just trade? Because it's a really effing good day job. Okay. I find it interesting. I'm doing good work and it pays really, really well. Okay. It pays well than like what most things do. And the amount of money that I make for the effort that I do compared to what I see a lot of other people do is just insane. But the reality is that it's a difficult skill that is in high demand and that they need and that they pay for. And actually, the reality is what I've discovered over the past year is that I'm actually probably underemployed. Like I could probably make almost 50% more than I am now if I found the right role and the right company. Okay. So what happens is you get these guys that they didn't grow up thinking they were going to be a computer scientist. That was me. I said, I want to make video games, and my dream was always to learn how to program. I was trying to do it on my own, and it wasn't until I got into university where I was really able to, they were able to focus me in on learning and doing it, right? Since then, I've learned to kind of learn things on my own a little bit better. But back then, I was just too ADHD to do it, right? So I came in, that's what I was going to do. And then you go out and you get a job, right? Well, these jobs are in such high demand that they're doing everything that they can to get people into it. So you'll get people that you go to a coding camp or whatever, you do all of the things like you do the leet code guides and all of this sort of stuff, and then you go and you land a job as doing quant programming. So you're not the quant, you're not the one that's coming up with the mathematical theories and figuring things out. Instead, you're working with that guy to program it and, deal with the infrastructure and all that stuff, right? So the reality is probably a lot of those guys could program it, but could they program it in the way that runs the best and that lines up with like the larger infrastructure that you have to have and everything else, right? Now you need a guy just for that, right? So when you go and you land that job, and the thing is that those jobs tend to be in areas of the country that are very expensive, right? So you're going to go in and you're going to land a job and you're going to be making like $200,000 all of a sudden, right? It's kind of hard to do that and not feel a little full of yourself, especially if you're brand new, because you probably don't have a large enough view of the industry as a whole to understand why you're getting paid what you are, right? So yeah, I totally see what you have, but I give them a pass on it because is what it is. Okay, but the question, is it true risk is managed by Greeks? Okay, so the risk management that I did was a very different thing. Okay, the risk management that I did was like, there is already a number decided that is like your credit limit, and we were more about the enforcement of the rule, which is to say some other system is calculating what is the number that you can do. My system was the one that says when somebody submits an order, are they actually to that limit? And if so, let's prevent that order from going through, right? So my system was more about being able to calculate everybody's position very, very quickly, right? Those systems, like thinking back on it and working on that is insane, because at the time, it didn't seem like too big of a deal to me. Like at the time, I was more concerned about KDB syntax and trying to memorize KDB syntax because it's so terse. Oh my gosh, it's if you really want to specialize in something, go and specialize in KDB, man, because you get paid serious bank for doing it. But it's like you'll just be doing that and you won't be touching anything else because it's just like so weird compared to everything else, right? But now I go back and I think about it and I'm like, I was literally calculating the total position of every client in every instrument 10 times a second. What the? That's like the regulatorily mandated amount is it has to be calculated every 100 milliseconds. It's insane. And the architecture that they have to do that is kind of weird and interesting. But that's what I was doing. So it was more about calculating things very, very fast, and it wasn't about like how do you calculate the Greeks to find out like what is the correct position. That's kind of something that maybe you would do more on the hedge fund side. Okay. But I do think that Coding Jesus, that is some truth in what he's saying, that a lot of, like if you work for Citadel, right? A lot of what they're doing in terms of risk management is going to be determined by things like Greeks. Like what your gamma is going to matter a lot, right? And I think that's the best. I don't think that Coding Jesus was working for Citadel, but I think he was working at a pretty similar shop, that they were market making options of some sort, right? So then, yeah, they do use those Greeks and that sort of volatility analysis sort of a thing to determine what are appropriate prices and so forth. But I would say that risk management is like a much more complicated thing than that. In my own framework, when I'm talking about the things that you need to have in a strategy, and risk management is one of them. Risk management is really like the statistical analysis of you and your strategy is what that is, right? Which makes it a really important source of edge, I guess you could say. You work with carnivore? No, I've never heard of that. I worked with so many different technologies there, Goldman. You know, I've worked with so many different technologies overall. Cause like the thing is I did, there's a predatory algo. Oh, okay. When I worked for Goldman, like one section of my time was just on maintaining the C# framework that all of their other applications were built on. So that was maintaining a library framework and like doing all of the support and so forth for that system. Okay, so that was one side of things. Then another thing that we did was building tools for the people that were doing deployments. Okay, which eventually changed because then Ansible came along and that was like good enough for most of what they were doing. So then everything moved to Ansible. Then I had a period where I worked on a testing system. So that was writing a GUI in C#, and it was also in dealing with the messages that go to the exchange and exchange connectivity. We did. So when I was there, most of their front applications were in C#, but about halfway through, they had made a strategic decision to basically shift everything over to web browser applications, and the C# framework kind of died. So that's around the time that they moved me over to becoming doing the testing things, right? So I wasn't running tests. I was writing a piece of software that they used to run tests. There was a simulator and there was a GUI, and the GUI was the thing that you would write the tests in, and that was the part that I made. I felt that we had a lot of success with that. I did a lot of really weird, interesting work. Although I was usually on the side of like, okay, like figuring out how to get the GUI to work and spending a lot of time figuring things out that like getting around the weird quirks and MVVM and that sort of a thing, right? Okay. Then when that was done, I worked on this risk management system. And then when that was done, I worked on a system that measured latency in microseconds. So those were the things. So like I did all this different stuff there, right? And then when I moved over to the company that I work for now, they wanted me because of the testing side of things. And basically what ended up happening on that one was that we did such a good job with those testing tools and helping the teams get their pipelines and their testing up to the point where they didn't need these kinds of tools to resolve their deficiencies anymore, that our group wasn't needed. So we did a good job. We got the job done, and then they moved us over to site reliability engineering. And then we've kind of even gotten past that because like we got all of the monitoring up, and now we're spending all this time on like cloud infrastructure, right? So when I go out into the job market and it's like, what are you going to do? It's like, well, I can do framework, you know, going back in order. Managing like a base level framework, GUI, C# GUI, React GUI, right? Testing and like managing testing, because we were basically like the managing all of the test plans had to go through us. Site reliability engineering, cloud engineering, and then on my own, I'm getting into machine learning and AI, and so it's like machine learning, AI, and AI infrastructure engineering, right? So I have like this really wide array of skills, places that I could go and do stuff, just because I always ended up being the guy being shoved to the forefront of wherever the new difficult thing was. So have you ever called it C hash just to rub it on someone? No. Dude, there was this video the other day where a guy came in and he's like, okay, I'm going to teach you how to say certain computer programming terms. It's pronounced GitHub. Oh my gosh, it made me angry. I wanted to punch the guy. He's like, no, it's not. It's GitHub. The fuck is wrong with you? Ugh. C hash. Okay, whatever. Okay, were you ever in a situation where you had to ring up the margin call directly to a desk instead of flashing a red light? No, so it kind of doesn't work like that. So there were situations where I had to talk to the risk controllers, yes. Because usually what it would be is our so now I'm kind of getting into things where I have to be careful about what I say about it. Part of our systems and what our systems did were not supposed to be well known to the traders, let's say. So like the traders kind of have to know that this is what's going on and assume that sort of a thing is going on, but they don't know of the system's existence. They don't know what its name is. They don't know how it works or any. They hid that from them. And especially after the London Well, because the London Well was basically doing the same thing that I was doing, and then became a trader and took advantage of the knowledge that he had in order to become a rogue trader, right? So what would typically happen is a trader has breached their credit limit or their risk limit. What's going on? Well, the only time that would ever happen is if they are carrying out, a large buy or sell operation that day, right? So when you're actually entering into the position, you use more margin or more credit than what the final position is actually going to be. So if you were carrying out a block order for somebody, right, they would have to request a temporary increase in their credit limit for that client or whatever, right? And so, we would get a breach, right? And then that would have to send a notification to the credit controllers, the risk controllers, and then we would have to modify the risk based on what they told us to do. No. I wouldn't be calling the clients or firms. No. Our system would be sending the notification and we'd be talking to the risk controllers, and the risk controllers would be the ones that would be talking to the traders in the team, block traders in the teams. Do programmers think that other people who can't code are subhumans? No. Maybe some programmers do. I don't know. Like, it's one of those things that I can't really understand the perspective of somebody that doesn't know how to program, because I just can't get myself into their mind, right? I know that I can program because it's something that I've been training and doing like my whole life, right? If you're already 30 and you haven't done that, it probably would be really hard to get into, right? Some people, their whole mind is your mind is a neural network. Some people's neural network is trained to interact with people, and some people's neural network is trained to interact with logic, right? So I think that I got into that whole discussion in there just because you guys were asking me questions. But the thing that I'm trying to get across to people when I'm telling you this is that number one, from like a programming and technical perspective, I have a very broad array of experience, and that's what allows me to be able to speak on so many different types of technical subjects. But the other thing is to point out to you that I was not a trader for Goldman. I was not working on the desk. I was not a quant for the desk. If I had learned those things from Goldman, I probably wouldn't be able to talk to you about it, right? The reason that I'm able to do what I do is because I had enough insight into the inner workings of the firm to understand what they were doing without actually being taught. And so then I was able to go back afterwards and learn that stuff on my own. And that's how I'm able to go and show you okay, here's the stuff that you need to read. Here are the key concepts that you want to figure out, right? Because I don't think that I would expect you to be able to just watch all of Seth's videos and then instantly become successful. Like you're still going to have to watch the market every day, read the news every day, and go and read. If you're going on the quant side, you're going to have to go and read these studies that I mentioned in these books and stuff on your own, right? So the YouTube is just not the format to do it, right? I had to learn it on my own. The trading part. Goldman didn't teach me how to trade. And that's an important part, is that I had enough guidance from them to know what to study, but I had to learn it on my own, and you're going to have to learn it on your own too. And that's where I think I provide one of the greatest benefits to new traders, is teaching you how to learn this stuff on your own, because that's what you got to do. Everybody wants this approach that I'm just going to learn from this one guy, I'm going to take a course and then I'm going to be successful. It doesn't work like that. You're going to have to research and find things on your own. How do you do that? What is the mental approach? Do you have to do that? It's hard, but that's what I can teach you, right? Is it late to start programming at 27? No. Especially so I think if I was just starting out, like React is a really great place to go in, because you can totally there is real demand for React programming. You can do really cool stuff with React programming. There's a lot of really good resources to learn React programming on your own. And if you're 27, you could totally do it. Now, the thing that I think you have to consider is, am I really cut out for programming, right? Because some people just aren't cut out for programming, right? If you're the kind of person that you hated math, you hate logic, you hate technology, logical driven things, because there's a lot of people out there, you know, like my brother and my sister and brother-in-law, they're in the theater and music and singing, and everything that they deal with is music and people and theater, right? And that's a completely different world from programming, and they would probably have a very difficult time making that jump. Now their kids are doing programming classes at a very, very young age, and they're very good at it, right? Because they're getting in there young, right? But if you're the kind of person that, like, most of what you do is with people, yeah, it might be hard for you to make that jump to programming, right? In your video about the types of trends, you mentioned this scenario: large liquidity being absorbed by same or more aggressive orders in basic way. How can we study order flow dynamics in order to understand, confirm, and trade this scenario? Okay, so the way that I approach that is that, number one, you can kind of, so like what you had just described was, you were describing a type of order flow, right? So this would be more likely to happen on an uptrend in the treasuries, where we get up to the highs and there's like some big icebergs and big orders up there, and the market orders just smash through them, and it goes through and it keeps going and going, and it's a very aggressive move the whole way, right? I'm describing type of order flow, right? So once you've seen that and you see that trend, then you know that that's what type of a trend it is, right? The problem is that by the time you figure that out, it's probably too late, right? It's already moved up. Is it actually going to continue further, right? So the other side of that is that you still need to predict order flow, right? So what you would want to do is to be able to come into a situation to say, based on this, so like I think a good setup for that sort of a thing might be that there is an area that has kind of had some support in the past, and there is some large flows that are coming through the markets because of end of month rebalancing or CTAs moving or whatever the deal is, and they're going to push through that liquidity very aggressively. And it's a Wednesday, so people aren't expecting it because it's not based on news, but I can predict that flow is going to happen, and then as I see it, I don't have to see very much in order to say, oh yeah, okay, I can get in, right? So the answer that you're looking for is you still have to predict the order flow, right? You want to know that is going to happen before it happens, and then use the things that you're seeing in the order flow to confirm that you're correct. I would be very, very wary about any kind of a setup in your trading that basically relies on only looking at technical data and then using that data to predict what's going to happen, because the market is very statistically efficient. It's very difficult to find a predictive edge from that. Whereas when it comes from an informational context, things that I know about flows that might come in today and everything, that's everywhere. It's abundant. Right. Sounds like it's about the context. Well, yes. But see, I really hate the word context, right? Because context is so amorphous and unspecific, right? Context to me is, I knew that it was going to happen, but I can't really explain to you how I knew it was going to happen, right? Which is not a knock on anybody that says that, but that's what they're kind of saying. I think the innovation that I've been able to give you guys is the actual like scientific and theoretical framework to actually explain that, right? We're looking for predictors of order flow. So if we combine predictors of order flow, correlated instruments, the actual flows that we're seeing right now, what we know about volatility in your own risk management, now you can combine that all together into coming up with an actual trade. But the place where the most of your edge is going to come from is from predictors of order flow. Information that you have that has a high probability of being able to predict the future orders, right? And what are possible sources of that? And if you watch my video on the inelastic markets, I go over that stuff, right? News is one of them. They kind of present a couple of possible sources of predictors of order flow, and I think from that list that gives you a pretty good starting point to figure out what are the things about the quote unquote context that I need to do to be able to make those predictions. Okay, which one do you think has higher flows? End of month, end of quarter, or what do you mean by M over M? MOM. Month over month rebalancing? I don't know what MOM means. The middle of the month? Oh man. So I think that if you're having middle of the month rebalancing, those flows might be really big and strong, but they might be more spread out and less obvious to us. So MOM, I feel like this is a trick question, and I'm thinking maybe MOM might, because I don't know anything about that one, that would be a candidate. But I would say pretty confidently, so here's another issue. When you have month over month or end of month rebalancing, say you have this much flow, right? And say the flow that only does it at the end of the quarter is this much, right? But when you actually see the end of quarter rebalancing, you're seeing both of these. You're seeing the end of the month and the end of quarter. So you definitely see stronger flows at the end of the quarter, right? Like that closing auction on the S&P 500 on at the end of the quarter is always absolutely nuts, right? But that's part of that is because you're getting the end of month and the end of quarter flows together, right? And I don't have the data to know how much of it only does it at the end of the month and only does it at the end of the quarter. I don't know. But what I do know is that I'm much more, I'm paying much closer attention to what the flows might be at the end of the quarter. Because when it's the end of the quarter, man, those flows can be so dominant. I mean, end of month flows tend to be pretty strong, but it can still be difficult to sort out what they're actually going to be, and you know, but you always see something, right? End of quarter can just be like, whoa, holy crap, right? I can't tell you how many times we've been here, like in the morning, it doesn't really do anything, and we're like, well, I guess we didn't get anything from it this quarter. But then, like into the close of the S&P, it's like, holy crap. They waited to trade it all at the very, very end. Middle of the month is usually referred to as 15 to 21 period of the month, to give you context. I don't know. I've kind of wondered how many strategies are there out there that are rebalancing on a much more granular or fuzzy kind of a framework, because I find it hard to believe that the majority of them only do it at the end of the month, for instance, right? That seems like dumb to me. That seems like you would only do that if you were really, really big and that was just like a really simple way to do it, but it's probably unlikely to be the most efficient way to do it. But I'm just guessing. That's just, or not even guessing, I'd say that's just my intuition of it, is that doing it at the end of every month would just make you too vulnerable, right? For hedge funds to try and take advantage of what you're doing. Do you think most people should give a try for trading? No, I don't. Not at all. I don't think at all, Jiffo. I think that trading is only for you if you have an intense burning interest in the market. Now, if you're looking to make money and you're young, then by all means go into finance. And if you're hungry and you're somebody that wants to work hard, the financial world will definitely accommodate you, right? But if you're older, right, and you're thinking, should I get into day trading, right? And you're thinking, well, I would really like to find a way to make more money, and it seems like day trading it might be the ticket for me. But you don't actually have that interest. You're not the person that is obsessed with reading CNBC or Zero Hedge every day and knowing what's going on in the market and trying to understand as much as you possibly can about it. You're not the person that's obsessed about what macroeconomics are or what the next Federal Reserve meeting is going to be. You're not the person that pays a laser focus on what companies' earnings are, and you're trying to like model out earnings on, you know, you don't find that stuff fun. Then, you know, you're going to be spending a lot of time on something that you don't really enjoy and that you're very unlikely to see a whole lot of benefit from. So, and it's going to be very difficult for you to continue persevere through the trial of day trading long enough to actually have success with it. So I would only recommend this to the people that are obsessed with it. Okay, the 10 largest players who use the bank as prime brokerage exclusively rebalance in the middle of the month. Well, that is interesting. But that's you get where I'm saying that like that's a pretty wide time period. So it would probably be more difficult for us to both see and take advantage of those kinds of flows. Although we could maybe take a look at that. I only traded one day 3 years ago, made 100 euros trading CFDs, looked at myself and my thoughts, and I got scared of how erratic it was. The uncertainty, you know, one of the things that I think is a really huge benefit of the kind of framework of trading that I use and that I've been teaching people is that if you have an edge, you should know it, and it should go your way. And if you're really trading well, I would think that you would win 50% of the time, not more. And when you compare that to what I would call noise trading, which is what most people do, where they say, here's like a specific setup and everything else like that. Like approaching that from a mental perspective is just like a nightmare, man, because you know, you're just at the mercy of chance. And how do you know that the statistics that you have are going to hold up? And what do you do when it's not? And you're constantly playing this mental game with yourself of like, is this the right situation to be doing it? Should I be, you know, am I crazy, etc., etc.? Like the reality is that when something is random, the head games that you play with yourself are nuts, right? Like people that are gambling, we know that gambling is random, and yet they come up with all this stuff like, you know, there's luck, and it's guaranteed to turn you into a basket case, right? And then the other side of it is, I would say that, like, well, you know, you don't really have to take on a whole lot of risk, right? So if you're doing it for the joy of it, then you're going to be okay coming in here and doing it for very minimal risk and reward, right? Yeah, you're not going to become a millionaire from doing that, but I think overall you'd be happier, right? I wish I had come to this kind of a framework a lot earlier, and maybe I would have less gray hairs on my chin, right? Well, that's how you get the correct price that you're happy with instead of a static price. Yeah. Well, doing it over that wide of a period would kind of suggests that you would get better execution, right? And so if they get better execution in that situation, that would also suggest that there's stuff about that makes it harder for us to predict and or take advantage of those flows, right? Despite that, you still see really, really strong flows at the end of the month and the end of the quarter, right? And I don't know. So, like, for instance, right now, the biggest thing continues to be that the sentiment is just dismal, that most of the hedge fund kind of players have positioned themselves short. And meanwhile, the CTAs are all kind of like being forced to buy it long. And so you're getting these like crazy short covering rallies, right? Like that is I think that's a flow that's a little bit difficult to, because, you know, you kind of have to look at it every day, right? But if you look at over the last few weeks and you were basing your trading just purely off of that, you would have made money. You would have gone long and you would have done okay, right? So that's been a pretty strong flow. And it kind of sounds to me like when this regime ends, that the stuff that's going on with the 0 date expiration options and everything else could result in quite a bit of volatility when this unwinds, and who knows when. I honestly kind of thought that we would be out of this spot after the CPI and the retail sales next week, but it didn't turn out that way, did it? I hate when that happens, when there's a particular data point you're waiting for, and so you think, okay, once we have that data point, then the market can move. And it's like you get that data point and the market moves, and then that's the end of it. And it's like the head fake, and then after that, it just turns back into purely all technicals. Ugh, hate that. I mean, a market that's driven by technicals like that can be advantageous to you, but when it flips on you so quickly, that's really hard to deal with, right? I'm just kind of realizing that as we've been speaking here today, that we've basically spent our entire time trading around 05. This is a really, really dead session for the treasuries in particular. I mean, the S&P 500 is pretty tight as well. It's been tight this week overall. It's trending up a little bit. So I would say it's bad, but it's not the worst. The treasury, this is in this, like, this is my least favorite kind of market. Because, like, the best thing that you can do is try and scout this range, and you're going to end up in these trades forever and have difficulty getting filled, and there's all sorts of problems from a retail trader perspective trying to trade that. And then you get this quick bust one way or another that you'll stop out on and lose, and then it'll go dead again. Hate it. Not your best kind of setups. You know it's bad when the CME is sending you emails with ESRC 200% jump in open interest and volume. Well, so riddle me this, because isn't the positioning in, well, I guess we'll have to see at the end of the week, but isn't the positionings in open interest in the futures still quite high? Kind of makes you wonder how it was able to get so quiet. It seems to me like there's some other kind of volatility dynamic going on here. I guess, have you noticed I'm like overly sensitive to that sort of a thing? Because when I first started trading in 2017, it was a very, very low volatility market, and it was extremely difficult to trade. ESRs are the euro equivalent of the SOFRs. Oh, geez. Only 500 contracts a day? Well, man, it's a little weird to think back on all of that, because, like, nobody wanted to trade back then. Like, when I started doing this, the public was so against trading. There was, like, you go on Reddit, there was no interest in trading. Trying to find other people to talk about trading was really, really difficult. And then you fast forward to 2020, and it was like freaking everybody was talking about it, you know? But and the people that were talking about trading were talking about how difficult it was. Like, it was unpopular because not very many retail traders were making money in that environment. And we've had a lot of volatility and all sorts of things have happened. I still believe that the natural dynamic of the market is probably going back into that low volatility regime where everybody sells VIX. Yeah, I have told you this before. The volatility between 2015 and 2019 was an anomaly, largely because the Fed openly admitted that they have a continuously rolling short position on the VIX futures, so most are just positioned for no volatility. No, I get what you're saying. So, but what I'm saying is, we're going to go back to that. Like, so you think about, there was that market, right? And then what happened after that? There was a trade war. And then after the trade war, there was COVID. And then after COVID, there was the rising interest rates, right? And then that takes us to where we are now. So if we ever went to a period where it was like, okay, the Federal Reserve got interest rates to the level that they want, and now they're going to keep interest rates there, and the interest rates stay there for like the next 4 years. And, you know, like inflation goes back to a little bit low. You know, the market is in a bull market, but like it's a very slow, gradual it's a really slow and gradual bull market, you know. I really think you can go back to this low volatility regime, man. For the change we see today are stuff that are cyclical, or stuff that happens today are meant to stay. Yeah. Well, okay. So to on my theory that like you have this tendency to move back into a low volatility regime, I would cite this week as an example. The fact that we've been able to morph into such a tight market so quickly, I think supports the theory that the market kind of has this tendency, when if there's not somebody sitting there rocking the boat, that it will just default back into this low volatility regime. Now, the thing that would screw all of that up would be information that suggests that this inflation is going to continue to be a problem for the next decade, right? And the 10-year treasury comes out and says, oh yeah, we need to be more like 5-6% or something like that. Then that would be a shift that would screw that theory up, right? But actually it says not the next 4 years. Well, the one thing that we got going on in the future here is going to be elections, right? So elections does drive trade to some extent. That's definitely gonna create some volatility and stuff, but if the 10-year yield goes to 6%, the market volatility will absolutely die. Yeah, well, it would. I mean, man, if they went up to 6%, like what would happen to the liquidity? Ooh, right? You would have a period. So again, I think it has to do with like the period where you're not shifting rates at all, right? If you go into a long time period where there aren't any changes in rates, that seems to be what leads to this extremely low volatility situation, right? Because I think you're right. If we pushed the yield up to 6 and then it stayed there at 6 for a really long time, I think that would probably tighten volatility even more. Because you're going into the same low volatility regime, but you're doing it with the liquidity even more damaged. You'll have such a crazy carry in derivatives. You will have peeps just buying cash and selling derivatives. Yeah, almost no speculative directional exposure. Right. But that would almost assume, yeah, I mean, like, so in the situation where interest rates went up to 6%, and it wasn't like they went up to 6% and then we held it. No, it was like there's continued drama. We're concerned like it's either going to be like another crazy, insane inflation print, or we're going to drop right back into a recession and kind of the environment that we had in 2022. Then I think that there would still be a lot of room for people to come in and speculate, right? But if you take it up to those interest rates and just hold it, then yeah, when it dies down, it's just going to be, it's going to be the most boring effing thing ever. It's going to be like, I'll come in here into the treasuries and put an order in at the very beginning to get filled, and maybe over the whole session I might be able to grab 2 ticks out of it, right? But don't you see the economy recovering in 2 to 3 years? I don't know. I'm not sure that I can see that far out. And I'm so okay. So like, think about where we were 2018, 2019, right? So like we had that volatility expansion, and then things kind of quieted down a little bit, but then things started to get bad again at the end of that year because of like the repo crisis and all of this sort of stuff, right? So at that time, it was kind of like, oh, okay, we're gonna have a little decline, but then like things should be good again. And then COVID came along, right? So what would have happened without COVID, right? Because the whole thing has been that since then we've had like 3 or 4 shows drop that you never would have been able to predict a few years ago, right? And you know, I have to think that probably continues, right? So you could, I mean, man, you could see all sorts of crazy stuff. Like so for one, you could have an election next year that drastically changes the political makeup of the United States, man. So like one of the things that you're seeing right now is like, so one of the talks is there are not many women voting for Republicans, presumably because of abortion, right? But Republicans still look pretty competitive, right? What happens if Republicans take the House, you know, just completely take over the government next year? I think there's a really good chance of that just because the Democrats have done so badly, right? And you might see like major shifts in the demographics. And on top of that, you're still having the AI revolution. Because let me tell you what, ChatGPT is trivial. ChatGPT is basically like a really sophisticated lorem ipsum generator, and it is not really actually the thing that's going to be driving the majority of productivity increases from AI in the long run, right? You're going to look back at ChatGPT and go like, oh, remember when we were so amazed by ChatGPT? That's just, it'll just look so silly compared to the things that are coming after it, right? That's all going to be happening. There's probably going to continue to be major geopolitical changes, right? Just tell everyone that Dems are hell bent on not allowing retail trading. You will at least have a whole... Okay, so dude, listen to this one. So there was this... Oh, I don't remember what the thread was about on Reddit the other day, but there was this person that was like, oh, it was about taxes. It was basically like the rich don't pay their fair share, which I'm kind of starting to get fed up with, just because it's like the rich are like the only ones that pay taxes these days, right? So this guy had this big long list of all of these things that he thinks that should be changed so that the rich can't evade taxes, right? And one of the things that he said was that there should not be any investment that's tax-free. Like basically saying that like if you're making over $200,000 a year from it or whatever the deal is, that not even municipal bonds would be tax-free, right? And I'm sitting here like, that is such a dumb idea. Like how would, if you had to pay taxes on municipal bonds, how would municipalities convince people to do it? Because I feel like that right now the only reason why anybody ever goes into that is because they're looking for the tax-free income, man. Like it would increase the borrowing costs for every municipality. How would you get anything done? It just seemed, I was like, this is such a dumb idea. And it really shocked me how, because if you get a post that's long, you know, people kind of assume that like, oh, they must have really thought about this. They must be an expert in their domain or really know what they're talking about. But like, I was looking at it, I was like, this guy is clueless. I can't believe that this guy thinks these ideas are a good idea. People with 9-to-5 jobs don't pay taxes nowadays. the majority of people are not actually paying taxes. You're getting more of a rebate than what you're paying in. The majority of people. So that goes back to that tweet that we read at the beginning of the day. Oh, hey, you getting pretty good downtrend and pretty good amount of volume coming through here now in the short. I'm not going to take it because it's so late in the session, but it seems like something's going on. I don't know if that's enough to get them to the lows, but that's way better than anything else that's been happening. I bet that guy is a barista at Starbucks with a master's degree in right. Anyways, the tweet that we read at the beginning of the day said that when you combine all of the state, local, and government spending, it's like 50% of GDP. Like, holy crap, guys. Shouldn't the goal be to get the government share of GDP as small as possible? Does anybody disagree with that? That the optimal situation is the government is doing everything that they want to do, and you get all of the cool programs that you have, but the government taxes as a portion of GDP is at all-time lows. That would be like the best situation. That would be like the situation that's never going to happen, right? Is that the government is being so efficient with its money that it's taking the smallest amount ever and it has the most amount of services and benefits ever, right? So why is it that every freaking policy that comes out of these people's mouth is something designed to try and increase the government's portion of GDP? Or let me take it a different direction. This is another one that just it just boggles the mind. What can these people be thinking about? So they come in and they complain, oh, it's all of these corporations, they're doing all of these nasty evil things. The whole economy is a game and you're not actually a player. You're just an NPC, and it's just these rich billionaires and everything that are the ones that are actually playing. And you know, you're just an object in the way of them accomplishing their goals, right? But then they don't say like who are the ones that are actually helping them do all this stuff? It's government. Like how do they do these things? They get government subsidies and they get the government to make the rules to go in their favor and against you. And then your answer to that is to give the government even more power to continue to help corporations and people abusing the system even more? Like what? It just makes my mind want to explode trying to think about the stupidity that's involved in that kind of thinking. That is the communist position, large share of government in the economy. Why do you find it surprising that all the people with far left leanings want more government taxes or more government involved? Yep. Well, the typical communist approach to it is if it's not working, you just need to be even more communist, right? Just do everything to cut the links between corporations and government? Well, I mean, this is the real conundrum, right? Is that so here's the side that we have to understand. This is where I think that libertarians have it wrong. That the market is not informationally efficient, and the market's tendency is to self-destruct. Like if you just leave the market alone on its own, there will be endogenous crashes. The market will fall apart on its own for not even any real reason. Like the libertarian view of it is, well, that only happens because the government gets involved and gives certain players advantages or disadvantages, and people take advantage of that to create these problems. That's not actually the case. Like the math is that the market will screw up on its own anyways. So you have to have government oversight of these things, right? So the question is, how do you have the government oversight over these things and create a system so that the government will actually create have the correct decisions on these things and not take that power that you have to give them in order for them to moderate the markets and turn around and abuse it. I'm not sure you can, right? And so what is the word? The compromise that you're going to have to make is you're going to have to accept less economic stability for more economic freedom and less government corruption, right? The price for less government corruption will probably be less economic stability. Are you talking about the bank? Well, no, but it inevitably leads to that discussion, though, right? Like, stop the fractional reserve lending or the gold standard plus less spending. Let me tell you something, Vig. So the narrative that has probably been presented to you is that the U.S. financial system was fine. We were on this gold standard and everything was peachy until 1907 or so, when there was this financial crisis, and then these bankers took advantage of that to create the Federal Reserve. And it was this big conspiracy when they made it, and then they eventually used that to undermine the dollar and create a fiat currency and move away from the gold standard, right? And that before that, like, everything was fine and we had a fully backed currency and everything. Okay, right? Okay, that picture that's being painted for you of like before the Federal Reserve is completely inaccurate. The reality is that this money printing stuff and the government coming in and manipulating the money supply has been happening since money has existed. All right. It happens inevitably. If you go back to like the earliest times when it wasn't the government and it was just a bank, the bank will say, okay, you put your gold here and then I'll give you a note. And then you know what they start doing is they start putting notes out and they don't back them with gold. It's inevitable that it happens. And I'll tell you why. It's because our plans will always be greater than our current resources. Because if you already had the resources to do something, you would have already done it, right? So all future plans are going to involve some amount of resource that doesn't exist anymore and that you have to borrow from the future, right? Debt becomes a necessary function, and that means that you have to print money that isn't backed, period. So all the Federal Reserve did, the Federal Reserve put in place, was meant to deal with something that was already happening. It was just that now it's actually done in a structured way and a less corrupt way, right? Now you have a board that is selected by the president and confirmed by Congress, and they have regular meetings and they report on their meetings, and there's transparency into the decisions that they're making and how they're doing it and why they're doing it, et cetera, et cetera, et cetera. Whereas before, they would do all of this stuff and they just kind of did it in private and you didn't want anybody to know about it. Right? That's what it is. And before the federal, when they did it that way, it wasn't, there was a lot of economic volatility because of it. That the period between when the Second Bank of the United States went down and when they created the Federal Reserve was the most economically volatile time in history. Let's see here. Apple, Google, Intel, all of them have headquarters based in Ireland. Do you know how much? Yeah. Well, this is another funny thing is they're all talking about, we need these corporations to pay their taxes, and then the corporations go somewhere else. So then they came in and they said, well, we need to have like these minimum taxes so that when we raise the taxes here, it doesn't completely screw us over. Okay. Because everything that I've seen is that the government's share of GDP tends to be pretty consistent. Like there's this narrow range, and we're nearing towards the top of that range, and we would rather be towards the bottom of this range. But like once you get to the top of this range, the government is taking so much that like people just stop working. Like it seems to me that the reality is actually that what liberals ultimately want to do is not physically possible. Like the amount of government spending and the amount of the size of the government compared to the GDP that liberals want is not possible. It's not sustainable. That your tax base just can't support it. So we've basically already gotten to a point where the government has gotten as big as it can possibly get, and the pendulum has to swing the other way. That's why I was saying that. So the narrative that you will hear, this is probably a last thought that I can share before I gotta go. There are situations when order flow is greater than normal? Absolutely. And the thing that's going to tell you that is what are reasons that people are going to trade? What can drive trade, right? A big piece of news that can really drive trade, right? A lot of people getting washed out of positions that can really drive trade, but you can absolutely predict periods where the order flow is going to be crazy, right? Wow. In Norway, they saw the highest taxpayers leaving when the proposal was to raise the wealth tax from 1% to 1.1. Jeez. Okay. Anyways, so the narrative that you're going to hear out there is like millennials are overwhelmingly voting Democrat, women are overwhelmingly voting Democrat, and Generation Z is really, really going to vote Democrat. And so conservatives are going out there on their last breath, trying to seize as much power as they can before they're just completely pushed out of power and everything becomes liberal forever. Okay, that's the narrative that you can be told. As somebody that's been watching politics now for the last 25 years or so, okay, that's what they say every year. And my understanding is from history is that that's what liberals have always said, is that the whole liberal position is premised on the fact that like eventually the society is going to do things the way that we want them to be done, right? And the reality is that it never actually turns out that way, right? Like even when the liberals win, it doesn't turn out that way. Like if the liberals win, then the liberals just fraction, and then there's going to be a fraction of the Liberal Party that becomes actually the new Conservative Party to some extent, right? That's just the way that people work. And this next election is one of those places where you could see one of those divergences, right? Where, because the issue is that some people are voting. Why are people voting on certain issues, right? Well, a lot of people are voting Democrat because of abortion, for instance, right? Okay. Well, what happens when the top issue is no longer abortion? What happens when the top issue is that Democrats have just absolutely fucked the economy and it's just not possible to cognitive dissonance yourself into believing that the Democrats should be allowed to completely trash the economy, right? Like there's going to be big shifts, and you're going to see like big generational shifts where the attitudes of large demographics change. It's coming. I'm telling you. We already kind of saw it happen a little bit, and then it fizzled, which is to say that like they didn't get what they wanted, right? So now people are going to take a different approach. Like they're gonna be saying the problems are still the same, but how we're gonna try and tackle it are gonna be different, right? So you're gonna see big shifts. It's coming, and those are probably going to be associated with both worldwide volatility and market volatility, in my opinion. And if we don't, and I think the minority situation, like the 40% situation where that doesn't happen, I see volatility just falling off a cliff. And I see intermittent periods of volatility falling off a cliff, like we saw this week. Seems like that's what we've moved into, is like when the market moves, it really, really moves. And when the market doesn't move, it doesn't do jack squat. So that's my prediction of the order flow from like a higher take. Nah, I didn't take a trade. It's too quiet of a day to try and take a trade, man. I mean, I guess we could have taken a short, but it was a pretty random move from my perspective. Really decent volume on it though. But definitely, I think if you were swinging, I guess you could have taken the short and said, I might have to hold it for all day, but eventually I should get lower, right? Yeah, well, whatever. How often do you wipe down your keyboard and mouse? About once a week, actually. Okay, it is time for me to get going. I will see you guys tomorrow. In the meantime, stay excellent, team.